Well, the new chairman of New York Community Bancorp, Alessandro DiNello, has bought up more than $200,000 worth of the company's stock. This comes as leadership tries to shore up confidence 2 weeks after the bank reported a surprise quarterly loss on the back of those loans in commercial real estate, around 25% the shares are down around 25% over the last 5 trading days. Let's bring in Yahoo Finance's David Hollerith to tell us more. David, what's the very latest?
Yeah, Kiko. So the new chairman is trying to he's purchased more stock, and he's of course the previous CEO of Flagstar, which NYCB acquired in late 2022. And he said on an investor call earlier this week that their main priority right now is to shore up confidence with the street, and that makes a lot of sense because they're in a tough position. A lot of their loan exposure is in commercial real estate, particularly in multifamily, which we don't hear about quite as much. It's specifically in multifamily in New York City, rent-controlled apartment complexes or loans tied to those properties. And so that's been difficult given a 2019 law, which has effectively capped the pace at which landlords can hike the rates of those apartments. Now, that was a long time ago, but given the combination of interest rates, landlords are losing their incentives essentially to renovate these properties, and so they're becoming more and more vacant, and they're also deteriorating in value a little bit faster than would be expected. Signature Bank also had a high exposure to these properties. And just to go back a little bit further, NYCB sort of made a niche for itself, catering to these landlords who also typically are large depositors or serve a large part of their deposit base. So that's kind of the dynamic. And what we're seeing now is that there's no easy fix to this. But that being said, DiNello is known for having turned around Flagstar after he started as CEO in 2013. So he's really going to come in here and he's going to do everything he can, which I think that has been the case so far, to show that the bank has a plan moving forward. One thing Bloomberg has actually reported earlier this week was that they may consider doing something known as a credit risk transfer, where they essentially try to improve their capital standing by taking off better assets on their book. But again, they can't sell their multifamily rent-regulated loans anytime soon, given that they would probably fetch a pretty hefty discount.
And so, David, with that in mind, how much should investors read into this as a story about wider bank troubles with commercial real estate, especially as that emergency lending program that the Fed put in place after the last regional banking crisis set to expire March 11th?
Yeah, Rochelle, right now it is really an ongoing debate about how unique NYCB's situation is. I mean, obviously, I think it's safe to say they have the highest exposure to loans tied to properties in New York City that are rent regulated and sort of facing this valuation issue. That being said, office has obviously been a topic for most of the past year in terms of that kind of exposure for regional banks. Smaller banks obviously have a lot more exposure compared to their capital standings, as opposed to larger banks, or the biggest banks, for example, really don't have this problem. But we are seeing higher rates of default in office buildings in downtowns across the country. So when we talk about commercial real estate, it's obviously very nuanced. There are a lot of different parts of that book. In multifamily, generally, it's looking a lot healthier than what we're seeing in this particular situation. But the office situation is obviously going to be higher of an issue for these regional banks. So generally, what everyone is doing right now is they're looking at interest rates, and they're kind of debating about how long banks can hold on and work out these loans that are potentially lost value with their customers.
Well, we're certainly continuing to see some regional bank stocks under pressure this morning. Appreciate you breaking it down for us, our very own David Hollerith.